Hello student, welcome back to IBS. Today we are going to learn about balance sheet overview, in which we are specifically going to learn about inventory. So now we want to know how we can value the inventory. So that is also one of the important. When you purchase particular inventory, there must be some price. Okay, so that price must be total cost. This cost should include your shipping cost, insurance cost, taxes, tariff, duty, storage, all the costs relevant or related to your inventory. So if you club all costs, then the total value will be considered as your inventory value. Okay, I hope it is clear to you. And out of this, there maybe we'll discuss in detail. We will not be considering into the inventories. Okay, now entry for inventory purchase. Okay, what would be the JV for your inventory? Obviously you will debit your inventory with your total cost, and you credit your cash, okay, or bank, whichever way you have paid. Or if you have not, you have purchased on credit, you will be crediting your vendor account. Okay, so when you will pay, that time you will debit your vendor and you credit your cash or bank. Okay, what are the issue we face with regard to inventory? So I think major issue is with regard to valuation of inventory. Okay, with regard to calculating the item ending inventory, with regard to how many item we have. Okay, if we are selling, suppose for FMCG, if you have been experience of working FMCG kind of companies, you must know there must be 10,000, 20,000 item we have. Okay, so in that item, this is not, I'm talking about the total quantity, this is the item we are selling. Okay, every item must be having 100, 200, 10 to 0, different quantity. So these are the item wise. We have 10,000 or 20,000 item, but every item, maybe I'm assuming average item is 100. So then how much would be your total inventory? Maybe this much. Okay, somewhere around 10 million is your total inventory quantity. So for evaluating this kind of company to total inventory is quite difficult. Okay, so for that also we have no other option other than to do the physical count and then figure out our ending inventory. Okay, even though if we make any mistake or something in calculating ending inventory, so that will automatically resolve in second year and in ending inventory physical counting. Okay, at that time ending inventory will be automatically corrected. That we will learn in future lecture. Okay, so first of all, valuation of inventory. Okay, as discussed, determine which is the specific item for the inventory included in the inventory at the year end. For example, we have purchased item 10 quantity, then we sold somewhere around 90 item, so we are having 10 item. So like this we need to figure out all the item. Okay, and their ending quantity. Okay, and then we will multiply by the price. Okay, price is also one of the challenge, what price to be charged, because when an inventory being purchased and the beginning of the period, maybe that time it's having cost of $8, and at the time of ending inventory, that time we are purchasing at the $10. So what cost we are going to charge, that also we will learn based on the method which is being applicable by IFRS and US GAAP. Based on that, whatever we are using the accounting method for calculating and evaluating inventory, so LIFO, FIFO, weighted average, based on that we will figure out the price. Okay, so each remaining item, what are the item has been remained and what would be the price, based on that we will be able to determine the item price or value. Okay, then we have lower cost or market value, whatever would be the suitable for inventory, that we will be applying into our inventory. For example, you have purchased a toy. Okay, you have purchased 10,000 different toys. Okay, and out of that you have 1,000 toys. Okay, remaining in your inventory. But as you can see, when you are selling to this to customer are saying, this is old item, we already have purchased and used, now it is, we can show me some new product or some new toys. Okay, so this kind of feedback if you are keep on getting, it means your inventory is not trending or something, you need to sell it on the discount or something. So for that you need to analyze your what is the market value of that inventory. If you go and buy the same inventory from same supplier, okay, so previous 2 3 years before, if you have purchased that inventory, that time maybe they are giving you $8 per product, but since it was trending, but now they might be giving you $6 that the same product, or maybe after 6 months or after 1 year, that product cost, they are decreasing because of the trend has been fallen or demand has been down. Okay, for this kind of reason, if you get this is the price, so earlier maybe if you are having 10 items, so your inventory value was $80. Okay, now since you have realized, if you go and buy from your supplier and freshly, then they will give you at $6. So now your inventory value is 60. So this will be your inventory value, and this is your lower cost. So you have to charge your lower cost, and NRV related stuff also we will discuss later in depth. Okay, for that you will normally you have to write off. You will obviously debit your write off account. Okay, and you have to credit your inventory. Okay, for this 80 minus 60 $20 entry. Okay, so this will be charged to your PNL. Okay, profit and loss or income statement. Okay, and this will reduce your current asset. So these are the method we will be going to learn in detail. These are just a snapshot. Then we will have to, then the last point is estimate the ending inventory. What they are trying to say, as we have discussed in the previous slide, let me go to there. Yeah, so when you have a beginning inventory, okay, and you have purchase inventory, so total we have hundreds of inventory and multiply by 10 is the price. So we have 1000 value of inventory. Okay, and as per income statement, this is a small amount. For example, this may be 1000, 10,000 k. Okay, and there are, this is the item, and you have all item has different 1000 k of product, or some of them has 200 quantity. So like this, that for, as I given you example for FMCG, you have thousands of different items. You cannot calculate physically. It will be a huge cost burden for you. For those kind of company, you have to apply some different method to calculate that. For that, what we will do, we will historical, we will see how much is our sales. Let's assume 100, and our cost of goods are normally 70, and our gross profit are always 30%. 30 is equal to 30 divided by 100. Okay, is our 30% is always our gross profit. So similarly, this year how much is our sales? Maybe our sales is whatever, let's assume 100 to make it easy. This is our sales, and our cost of goods would be how much? 70. Like 100 into 30% would be our 30 is our gross profits. If you know your gross profit 30, so obviously your cost of goods should be 100 minus 30 is equal to 70. So we know that this is our cost, and we know our total beginning and purchase. So we assume that our total inventory, and this may be 110. Okay, so total beginning and including of your purchase inventory, our total available cost available for sales is 110. This one I'm talking about. Then we will minus our 70 is our estimated cost of goods. Okay, based on our gross profit margin from the previous or historical data. Then we will divide, we will got our ending inventory balance. Okay, in this we have reduced this, so we got the ending inventories, and this is what, this is not actual cost of goods, this is estimated. Okay, to close our financial reporting, because we have no other option, because this is quite costly and we cannot do it. It will take huge time or something, or maybe huge money. Still we are not sure whether we are accurate or not, because I have seen in FMCG company, when we go for audit, okay, to a store, there are 120 different stores, so it will take around 30 days to do the calculation, and all the time we have to close the business for at least for 12 to 18 hours. And if we started in night, and next day till evening we are working. Okay, so like this we are unnecessary stopping our operation, so that is not going to give us any benefit other than just increasing our cost. Okay, I think I have explained this in detail. Thanks for watching. See you into the next session. Stay tuned. Thank you very much.